Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a divorce valuation expert in St. Louis, Missouri. I have the pleasure of discussing fraud in times of divorce and following the money trail with Jason Pierce, a forensic accountant in Boston, Massachusetts. Let's talk about one thing that you mentioned, which is personal goodwill.
Yep.
This is a concept, and I want you to talk about the concept. But most of the time, when you get to a divorce with a business valuation and an owner, it doesn't matter what the business is. The business owner believes that the business is worth nothing without them.
What?
All right. Every single time. This business is worth nothing if I were not in it. But that's the segue into kind of what is truly personal goodwill. So let's talk about that a little bit, the difference between personal goodwill and company goodwill. Because I try to say one's attached to the person, one's attached to the company.
Right.
But tell us more about how that is important in divorce.
Yeah, for sure. And it's kind of back to that scale where you've got a person in a truck. On this side, it's a job, even think like hairdresser and a chair, all the way up to, multi-levels of management, maybe different locations in different states, a board of directors, things like that are tilted on the other end of the spectrum. But what happens when you're closer to a job, maybe you've got the business owner and a couple folks. At what point does it stop being in like an income type case and to where you have that residual or that enterprise or the company goodwill that you were talking about? It's tricky, especially the smaller they get. And one of the things I'm sure we'll talk about today is like the calculations versus conclusions. I testified to a business that had $250,000 of revenue. Why? Didn't make any sense at all. So certainly there was some more like conflict over and above like the business itself. And clearly that was a job, but they had a lot of subcontractors, so it did kind of factor in. But I think that understanding how the business works from what does the owner do? Is this an owner that I had this case where he lives in Florida and everybody else just did the work? And he was his LinkedIn profile was him with the shirt off, and he was a fishing captain in Florida, but he had this cash flow heavy business. And of course he was saying like, yeah, this is all me. Okay. So you got to understand what they're doing. How many other people are there? Is there any sort of way you can chop up the revenue and say, okay, this relates to your staff or other billers who originate the revenue? Is some of this relate to like the equipment? Think like a medical practice where they have an x-ray machine, and just try to chop it up into products versus services or whatever. And once you get that level of understanding and you see that the business owner is participating, but they're only responsible for say 30% of the overall revenue, and they've got 5 other people that make up the other 70% of that. Okay, now you may have a situation where there is some personal goodwill, but it's diluted by the fact you've got some other folks. And so I think the idea is if you're going to say you're a superstar, and okay, we'll give you superstar wages, but if that superstar wages takes the profit margin down to 0 or negative, that doesn't make any sense either. So if you are such a superstar that you could command superstar wages, there should be a superstar return at the end of the day. And so then how do you quantify that based off the benchmarks? And I think that's where you get into like the multi-attribute utility model. See some of that, like the MUM. That's definitely making a resurgence, at least in Massachusetts. I don't know. What about Missouri?
Yeah, we will see it in Illinois. But Missouri is a little bit different. So we have a couple cases that tell us to do a few things mildly different. So, but I think
they started in Illinois, right?
What?
That's where it started. Is in Illinois, right?
Yeah. So, but I think that's the issue is how do you then quantify the personal goodwill? And the reality is every single state is different again. And a lot of it is subjective, so it comes down to the analysis and do you have something that's supportable and that makes sense? Now, what I like about Massachusetts is when you're getting to value to the holder, that's that's logical. Like that makes sense. Like what is the value of this business to this person as opposed to selling it outright? Because a lot of times this business creates the income and the wealth of the marriage and the family. And is there anything left over? Or is everything going to that person? But it does bring up some interesting pieces.